Here we want to compare between two bonds. Which one has the higher yield to maturity? The first one is a 20-year bond selling for £8,000 with the face value 10,000 with the current yield 20%, and the other one is a 1-year bond selling for £8,000 with the current yield of 10%. Of course, we are going to choose the bond with the higher yield to maturity. To calculate this, first of all, the first bond, which has 20-year maturity lifetime, the current yield equal 20%, which means that the yield to maturity will equal to the current yield, which is 20%. Why is that? Because we have learned that the current yield can be used as an approximation for the yield to maturity for long-term bonds, 20 years bond or more. So the first bond, its yield to maturity is 20%. The second bond, its current yield equal 10%, which means that the coupon payment over the price equal 10%. The price of the bond equal £8,000, which means that the coupon payment equal 800. In this case, we can calculate the yield to maturity according to the rule we have learned. Price of the bond will equal the coupon payment divided by 1 plus I plus the face value divided by 1 plus I. So, the price of the bond will equal, we can make substitution, 8,000 will equal 10,800, which is the coupon payment plus the face value divided by 1 plus I. Here we can get that the I, which is the yield to maturity, equal 35%. So we are going to choose the second bond because it has the higher yield to maturity. Here we are going to study a new concept, which is the rate of return. The rate of return is different from the yield to maturity. احنا أخذنا yield to maturity إنه measurement أنا بحسبه لنفسي in order to know what is the interest rate that equates the present value of cash flow payment received from a debt instrument with its value today. It's a kind of forward-looking, it's a prospective measure. I'm trying to make my decision whether to purchase the bond or not. So we decided to choose the bond with the highest yield to maturity to purchase. The rate of return is considered as a retrospective measure. It's backward looking. It means that after purchasing the bond, if I decided to sell it before it matures, how good investment it was. So I calculate what we call the rate of return. The rate of return is the amount of payment to the owner plus the change in the security's value. How to calculate it? The rate of return equal the current yield, which is the coupon payment over the price of the bond at the time t, plus what we call the rate of capital gain, which is the difference between the price of the bond at the time I'm going to sell the bond, which is t plus 1, minus the price of the bond at the time t, which I have paid already to purchase the bond, divided by the price of the bond at the time t. Here, the rate of return includes the income earned and the capital gains or losses from the bond. In order to understand that, look at this example. Here's the example. What would be the return for a 1,000 face value coupon bond with a coupon rate of 10% that is bought for 1,000, held for 1 year, and then sold for 1,200. ركزوا معايا يا شباب. أنا هنا عندي bond I have already purchased. الفيس value بتاعته 1,000 والبرايس بتاعه 1,000. For some reason, I decided to sell the bond before it matures, okay? I hold it only for 1 year. and the price of the bond now, if I decided to sell it, will be 1,200. I want to know how good investment it is to sell the bond now or not. So I have to calculate the rate of return. Here, the yield to maturity of the bond equal the coupon rate, which is 10%. How is that? Because the price of the bond equal the face value. The price I have paid to purchase the bond is 1,000, which equals to the face value 1,000. So the rate of return will equal the current yield, which is the coupon payment 100, plus the price of the bond at the time t plus 1, which is now 1,200, minus the price of the bond I have paid already to purchase it, 1,000, all divided by 1,000. Here we can see that the rate of return will be 30%, while the yield to maturity was only 10%, which means that there is a capital gain from selling the bond equal 20%. That's clear. أنا اشتريته ب1000 وهبيعه ب1200، يبقى أنا اتحقق لي فيه كسب رأس مالي يعادل 20% لو أنا بعته دلوقتي before it matures. هنا يا شباب أنا يهمني إنكم تركزوا على الفرق بين الاتنين. أنا اليلد تو ماتيوريتي ده اللي أنا كنت بحسبه مستقبلا آخد قراري أشتري البوند ولا لأ، فأنا بحاول أحسب البيس البريزنت فاليو لكل الانترست الكاش فلو payment received from the bond، علشان احاول اشوف ايه الريت اللي يساوي بينها وبين الفاليو اللي انا هدفعها today. هنا اليلد تو maturity equal to the coupon rate which is 10%، لكن الريت اوف ريتيرن اللي هيتحقق لي من البوند اوريدي بقى اللي اتحقق لي من البوند خلال فترة امتلاكي له during the holding period مساوي للكرنت yield اللي انا received from the bond الكوبون payment اللي انا بالفعل اخدتها plus the capital gain المكسب الرأسمالي اللي اتحقق لي اللي هو بيعادل 20%، لاني انا اتحقق لي مكسب 200 كبرسنتج من ال 1000 اللي انا دفعتها، لاني هبيعه ب 1200 وانا اشتريته ب 1000، فاتحقق لي كده فيه كسب 20%. فهمتوا قصدي يا شباب؟ يبقى الريت اوف ريتيرن مختلف عن اليلد تو ماتيوريتي. تمام؟ Notes please that the rate of return on a bond will not necessarily equal the yield to maturity on that bond. Okay? Why is that? Because the rate of return on the bond, it tells me the return on the bonds, how good an investment it has been over the holding period. While the yield to maturity, it assumes that I'm going to receive the same coupon payment till it matures all over the whole period. But the rate of return, it calculates the return I'm going to receive from holding the bond before it matures. That something must be very clear to you. To understand the difference between the interest rate and the rate of return, let us look at this table. In this table, it gives you the returns on different maturity 10% coupon rate after holding them for 1 year. Will the interest rate rise from 10% to 20%? يعني أنا عندي زي ما هو واضح كده من column 1 إن أنا عندي different bonds ليهم different maturities. Okay? هنا جايب لي ال years to maturity when the bond is purchased زي ما احنا شايفين 30 years, 20 years and so on. The second column, which is the initial current yield calculated as you know, the coupon payment over the price. Here the coupon payment, 10% of the price, which is 1,000, is 100, over the price 1,000 equals 10%. So the initial current yield, as you can see, is 10%, which is equaling to the coupon rate 10%, because the initial price equals to the face value, which is 10%, which is 1,000. Here the initial price was 1,000, okay, this the third column. And the fourth column, there is the price next year. Here the price of the bond changes according to the changes in the interest rate. The interest rate rises from 10 to 20%, which means automatically that the price of the bond will decrease, because as we have learned, there is an inverse relation between the interest rate and the price of the bond. So this column number 4 was calculated according to the formula we have studied, which is the price of the bond equal the coupon payment over 1 plus I to the power n plus the face value over 1 plus I to the power n. Here we are going to know what is the rate of capital gain. The rate of capital gain is the difference between the price of the bond now and the initial price of the bond I have paid to purchase it divided by the initial price. When we calculate, there is a capital loss, as you can see, because the price of the bond now, if I decided to sell the bond, for example, for the first case, if I decided to sell the bond, I'm going to sell it with $503, while I have paid $1,000 to purchase it, which means that there is a loss which equals to the difference between 503 and 1,000. So the rate of capital loss will equal 49.7%. This loss is called what we call it's a paper loss. دي خسارة على الورق. خسارة على الورق ليه؟ If I decided to sell the bond now. لكن طبعا هنا لما أنا هلاقي إن price of the bond دلوقتي أقل من ال initial price يبقى I will lose too much if I decided to sell it now. So it's called as a paper loss. It's a paper loss ليه؟ لأنها لو حصل rise في ال interest rate, which means that the price of the bond falls, it means that the bond experienced a capital loss. This loss is recorded on paper. But if I decided to sell the bond already, there will be a real loss. It's not a paper loss, it will be a real loss. Then to calculate the rate of return at the last column, it is the summation of column number 2, which is the initial current yield, plus column number 5, which is the rate of capital gain. As you can see, the rate of capital gain with negative values, except for the last value. We are going to speak about it in much details. You can see that the rate of return was negative for the first 4 bonds. How is that? Although there is a positive current yield, but there is a capital loss which exceeds the current yield of the bond and make the rate of return of this bond is negative. Please concentrate. The only bond whose returns equal to the initial yield to maturity was the last bond, which has time to maturity equal to the holding periods. The last row, the maturity lifetime of the bond is 1 year, and I'm holding it for 1 year. So the price next year will be the same, 1,000. There will be no difference. How is that? Because I'm going to receive the face value. So there is no difference between the price at t plus 1 and the price at t, because I have purchased it with 1,000, and now if I'm sell it, it matures, so I'm going to receive the face value, which is 1,000. So there is no capital gain or loss. That's why the rate of return on that bond equal 10%, which is totally equal to the current yield, which is the yield at maturity here. Here, we must know that the return equals the yield to maturity only if the holding period equals the time to maturity. Like in the table, when the lifetime of the bond, the maturity lifetime is 1 year, and I'm holding it for 1 year, so the return on the bond equals the yield to maturity. How is that? Because there is no capital gain or loss, as the price in the time t plus 1, which is now, will be equal to the price of the bond I have paid already at the time t, equal to the face value. ليه؟ لأن هو عمره سنة، وأنا لو بعته دلوقتي هو خلاص ده matures، فأنا going to receive الفيس value. يبقى السعر اللي أنا هبيعه بيه هو السعر اللي already هياخده حامل البوند ده، لأن هو خلاص it matures اللي هو 1000 جنيه. يبقى هنا في الحالة دي الفيس value equal the price of the bond equal the price at the time t plus 1. so there is no capital gain or loss. إذن the rate of return will equal to the yield to maturity. That is what will be received at the end of the maturity, which is the holding period. But take care, when the maturity lifetime is longer than the holding period, it means that the interest rate will change, which will lead to changes in the prices of the bond. As you know, if the interest rate increases, it means automatically that the price of the bond will decrease, so there will be a rate of capital loss. So you must take care that if there is changes in the interest rate, it will lead to changes in the price of the bond. So the rate of capital gain will change, and then the rate of return will change. It will not be equal to the yield to maturity. If there is a rise in the interest rate, it is automatically associated with a fall in the bond price. We have studied that there is an inverse relation between the yield to maturity, which is the interest rate, and the price of the bond. The increase in the interest rate will lead to decrease in the price of the bond, resulting in what we call a capital loss if the time to maturity is longer than the holding period. And vice versa, if there is a decrease in the interest rate, there will be a rise in the bond price, resulting in a capital gain if the time to maturity is longer than the holding period. Keep in mind that the more distant a bond's maturity is, the greater the size of the percentage price change associated with an interest rate change. Keep it in mind, it's very important. Please keep in mind that the more distant a bond's maturity is, the lower the rate of return that occurs as a result of an increase in the interest rate. Here I have three cases. If the holding period equal to the yield to maturity, the rate of return on the bond will equal to the current yield or the yield to maturity. Why is that? Because there is no capital gain or loss. The second case, if the holding period is less than the maturity lifetime of the bond and there is an increase in the interest rate, it means directly that the price of the bond will decrease, which means that there is a rate of capital loss, and this loss could exceed the yield from the bond and leading to a negative rate of return on the bond. The third case, if the maturity lifetime of the bond is longer than the holding period and there is a decrease in the interest rate, it will lead to an increase in the price of the bond, and this is lead to a rate of capital gain, which means that the rate of return would be much higher than the yield to maturity. Even if a bond has a substantial initial interest rate, its return can be negative if the interest rates rise. To sum up what we have said, returns will differ from the interest rate, especially if the price of the bond experiences sizable fluctuations that produce substantial capital gains or losses. Related to what we have said, there is a concept which we call the interest rate risk. The interest rate risk, it is the riskiness of an asset's return that results from the interest rate changes. In the previous examples from the table, we can see that the rise in the interest rate from 10% to 20% leads to dramatic changes in the prices of the long-term bonds, which leads to rate of capital losses, leading to a negative rate of return. Here is what we call the interest rate risk. As we have learned, the prices and returns for long-term bonds are more volatile than those for shorter-term bonds. From the schedule before, you can see that the highest rate of capital loss associated with the longer term to maturity, for 20 years bond and 30 years bond and vice versa. Why is that? Because long-term bonds respond more dramatically to changes in the interest rate. That's why we can say that changes in the interest rate makes investments in the long-term bonds quite risky compared to short-term bonds. Unlike the long-term bonds, the short-term bonds experience no interest rate risk, especially for bonds whose time to maturity matches the holding period. Why is that? Because the price at the end of the holding period is fixed at the face value. So, any change in the interest rate will have no effect on the price at the end of the holding period for the bonds. So, the return will be equal to the yield to maturity known at the time the bond is purchased. Please keep in your mind that the return on a bond, it tells you how good an investment it has been over the holding period. This rate of return is equal to the yield to maturity in only one case, when the holding period and the term to maturity of the bond are identical. Bonds whose terms to maturity are longer than their holding periods are subject to what we call interest rate risk. Why? Because changes in the interest rates lead to capital gains and losses that produce substantial differences between the return and the yield to maturity known at the time the bond is purchased. The interest rate risk is very important for long-term bonds. Why is that? Because it makes long-term bonds not considered safe assets with a sure return over short holding periods. If we want to calculate the current yield, the expected rate of capital gains, and the expected rate of return for a face value bond of $1,100 has a coupon rate of 5%, its current price is $1,040 and expected to increase to $1,070 next year. First of all, to calculate the current yield equals the coupon payment over the price. The coupon payment is the coupon rate, which is 5%, times the face value, which is 1,100. So the current yield will equal 5.3%. The expected rate of capital gain is the difference between the price at the time t plus 1 minus the price at the time t divided by the price at the time t. So the expected price next year is 1,070. This is the price at the time t plus 1 minus the price 1,040, which is the current price, divided by the current price. So the rate of capital gain is 2.9%. The expected rate of return will equal the current yield plus the expected rate of capital gain, which means it will equal 8. If the financial advisor has just given you the following advice: long-term bonds are a great investment because their interest rate is over 20%. Is the financial advisor necessarily right? What do you think? Of course no, because if the interest rates rise sharply in the future, long-term bonds may suffer such a sharp fall in the price, so there will experience a huge capital loss, so the return might be quite low and possibly even negative. If the interest rates decline, which would you rather be holding? Long-term bonds or short-term bonds? Why? which type of bond has the greater interest rate risk. Of course, I would prefer to hold long-term bond, as if the interest rate decreases, it means that the price of the bond will increase, and it will increase more than the price of the short-term bond, leading to a more increase in the rate of capital gain, which means that the rate of return will increase. Of course, long-term bonds are the bonds with the greater interest rate risk, as they experience more price fluctuations compared to short-term bonds, so they have higher interest rate risk. We must differentiate between the real and nominal interest rates. Nominal interest rates makes no allowance for inflation, while real interest rate is adjusted for the changes in the price level, which is the inflation, because we subtract the expected changes in the price level from the nominal interest rate. Again, we can say that nominal interest rates make no allowance for inflation, but real interest rate is adjusted for the changes in the price level, so it more accurately reflects the real cost of borrowing. You know that we can make similar distinction between real and nominal returns. Real return indicates the amount of extra goods and services that can be purchased as a result of holding the security. Keep in your mind, in order to guide well how people will respond to what is happening in the credit markets, please guide with the real interest rate, not the nominal interest rate. For the real interest rate, we must differentiate between the ex-ante and the ex-post real interest rate. The ex-ante real interest rate is adjusted for the expected changes in the price level, while the ex-post real interest rate is adjusted for actual changes in the price level. So, ex-ante real interest rate, it is what economics mean when they refer to the term real interest rate. But ex-post real interest rate describes how well the lender has done in real terms after the fact. Fisher equation, it states that nominal interest rate I equals real interest rate IR plus the expected inflation rate pi. You know that when the real interest rate is low, there are greater incentives to borrow and fewer incentives to lend. To understand that, I will give you a simple example. If you had made a simple loan with 5% interest rate and you expect the price level to rise by 3% over the year, the real interest rate will equal the nominal interest rate minus the expected change in the price level, so it will equal 2%. What is the meaning of that real interest rate is 2%? It means in real terms that you expect to have 2% more at the end of the year in terms of real goods and services you can buy. Another example. If the nominal interest rate is 8% and the expected inflation rate is 10% over the year, here the real interest rate will equal negative 2%. It means that although you will receive 8% more dollars at the end of the year, but you will pay 10% more for goods. So you will be able to purchase 2% fewer goods at the end of the year. You are worse off in real terms. So the real interest rate is a better indicator of the incentives to borrow and lend. You must keep in your mind, if the real interest rate is low, As a lender, you are clearly less eager to make a loan in this case, because in terms of real goods and services, you have actually earned a negative interest rate of 2%. By contrast, as a borrower, you fare quite well, because at the end of the year, the amount you will have to pay back will be worth 2% less in terms of goods and services. This figure shows you the relation between real and nominal interest rates on the 3-month Treasury bill at the United States from 1953 till 2014. You can note that nominal and real interest rates often do not move together. When the US nominal rates were high in the 1970s, for example, real interest rates were actually extremely low, often negative. If mortgage rates rise from 5% to 10%, but the expected rate of increase in housing prices rises from 2% to 9%, are people more or less likely to buy houses? Here we have to calculate the real interest rate. The real interest rate previously was equal 3%. It is the difference between 5% and 2%. While now, the real interest rate is 1%, which is the difference between 10% and 9%. Then, the real interest rates when purchasing a house has fallen from 3% to 1%. The real cost of financing the house is lower, and hence people are more likely to buy houses even though nominal mortgage rates have risen. Assume you just deposited 1,250 into a bank account. The current real interest rate is 1%, and inflation is expected to be 5% over the next year. What nominal rate would you require from the bank over the next year? How much money will you have at the end of 1 year? If you are saving to buy a fancy bicycle that currently sells for 1,300, will you have enough money to buy it? Here, start to solve this problem. First, what nominal rate would you require from the bank over the next year? Of course, you know that the nominal interest rate will equal the real interest rate plus the inflation rate. It's 1% plus 5%, it would be 6%. How much money will you have at the end of 1 year? Of course, it will equal 1,250, which is the money I have deposited, plus the interest payment I will receive it on this amount, which equals 6% times 1,250, so it will equal 1,325 pounds. Okay, at the end of the year, I will receive my money, which is 1,250 plus $75 as interest payment. If you are saving to buy a fancy bicycle that currently sells for 1,300, will you have enough money to buy it? It depends whether the price of the bicycle increased with inflation or not.